Welcome everyone. How we doing? Doing good, man. Another fun day in the market. Kicking myself a little bit. I had some Apple calls that I cut on the bounce into close. Shouldn't have cut those apparently. Ryan, how we doing? Yeah, they got some news. Ain't nothing technical about Apple doing that. They had some AI something or another. Apple ready's AI tool to rival Microsoft. But I hit calls here, took half of them off here, cut half of them somewhere around here for a loss, and then this happened. I think it's already happening. I saw that after I saw that news. Let's see if they have it on here. Oh no, see now we got Meta and Apple are fighting over advertisers. So yeah, Apple just been a bad news magnet, which is very unlike Apple, that's for sure. Data, yep, we got data in the morning, PPI, just a slightly more important inflation thing. But they are predicting it to come in a little bit hot. So we'll see what happens. But I'll be interested to see because PPI is normally more leading than CPI. PPI, it's the producer price index. And so, it tells us, are the producers paying more to make things or not? And we saw in the last PPI last month that they were, which is pretty common coming off the holiday season. You'll normally see a slightly higher PPI through that December, range. And then as the new year starts and the holidays are over, you typically still see it up a little bit just because they're making up for everything they sold. They want to get their stocks, their back supply back up. So we'll see. Predicting it a little bit hot. We'll see if it comes in hot or not. I'll be interested to see. I had a pretty good week, so I actually didn't take any cheap bets on this one. Welcome everybody. Sunny, how we doing? How's everybody else's day? We have a good day in the market. It was a pretty fun one. I love days where both sides can make some money, Big day today. Love to hear it. It was a good day. Some things were running. And we'll give it a few more minutes here. I don't know, man. I don't know. Everybody's got a lot of opinions on it, but nobody's actually reading about it. They're just being enthralled by the run that it's on. This run, though, man, as you read more and more about it, I mean, the company is not a fake company. They're actually, doing some things. And then uh, they have some things in the market that are working for them to make some very big moves. I mean, it's one of those things that there's no telling where it stops, I mean, it stops when people stop buying it. But, at this point, there's just, I mean, as long as people want to keep clicking buy, that thing's going to keep on going. I don't know, I saw something ridiculous that, and I'm seeing it right here. It's had 5 red days this year or something like that. No, I guess the year started here, so it's at 10 red days in 2 months, a month and a half. That's just insanity. But there's no telling where this thing wants to stop. It can go as long as people want to buy it, it will keep going. And there's just, I was even talking about this on Trade for just a very small amount of shares available. So that makes it extremely easy to move. People always try to complain about, low volume, but what they don't realize is low volume typically makes it dramatically easier to make moves happen. That's why frequently on those low volume days, you'll just see steady grinds in one direction. Something like SMCI that, and it's hard to know exactly what people are doing with their shares, but they got 47 million total shares, and not exaggerating, 85% of them are tied up by insiders and institutions. I mean, it's 70% institution owned. So I mean, they're trading their shares intraday likely, but they're ending up with the same amount of shares by the end of day every day, And so that really leaves about 7 million shares total to be traded. So that's why you see these just like ridiculous candles on it. Like I was looking at this one, this candle has 70,000 volume and it moved $30, So those are the type of things that happen on low float stocks, and that's just, I mean, we're just seeing, somebody asked me about it earlier, and it's a market inefficiency. Like it's just the market getting ahead of itself and getting to this point where there's no stopping it. One of the insane things to think about is the many, many, many millions of dollars that those institutions are losing due to this run, because everybody forgets, and I guess we'll kind of slowly get rolling here. Let me make a post real quick. So something that like people aren't really talking about and how insane this run is, and they often don't think about with an option contract, you are buying it from somebody. So if you are making money, they are losing money, as it stands, because they sold you that call at a price. And now if they want to buy it back and not lose their shares, they have to pay a higher price. So when you have a day like today where, you could have bought 900 calls. I guess we didn't quite get down there, but for easy math, you could have bought 900 calls yesterday, and now they're $100 in the money. That means that somebody is $10,000 underwater per contract on those 900s. So that's the only interesting thing to me to think about, is that the people who are selling these derivatives to the market are getting just blown out of the water. I mean, I'm sure they're doing multi-leg things where they're trying to buy legs and sell legs intraday, to try to reduce those losses. But at this point, as long as people keep buying, the people selling the derivatives, which is the institutions that own 70% of the shares, are getting absolutely obliterated. I mean, just destroyed. When you think about, SMCI is a fun one to think about, and this all kind of plays into the Greeks on a contract, and that's what we're talking tonight. When you're in the money, generally speaking, And it's not exactly like this until you get real deep in the money, but the person who sold that option contract when you're in the money is losing between $70 to $100 a day. So, or a dollar, sorry, not a day, a dollar that SMCI moves. So when you think about the people back here that, they sold 650 calls, and now those 650 calls, you're sitting $350 in the money. Those people who sold those are down $35,000 per contract that is sold. So, and there's thousands of them. So when you start to really think about those numbers, the institutions are accruing a gigantic loss selling options on this, and really aren't capitalizing much on this run on the shares. There's no denying that, like, whatever this thing's done, multi-thousands of percent since Norman told us about it, even cut further back than this, they've just been obliterated on all of their option sales. So it's a kind of interesting thing to think about. Okay, but with that, welcome everybody. Dirty River, happy to have you. Tonight we are talking option Greeks. Well, no, that's the interesting thing, J-Dub. It's not, because they have to sell against personal things, generally speaking. They have to sell against holdings of the company, not holdings of the customers. So they have to be kind of treated differently, So, there's probably some 401k people out there that their 401k holds SMCI and it is printing them money, while the person providing that 401k is selling calls against their shares to try to make money, getting absolutely scorched. Okay, but with that, Greeks. I love option Greeks. I think that there's something that people should spend. You don't need to like super nerd out. You don't need to know all the intricacies, all the ins and out of option Greeks. But I think that it is something that everybody should pay a little bit of attention to. I get DMs all the time of people in contracts, and they'll say something like, Tesla, for example. Oh, Flips alerted 190 Tesla calls. I'm in 240s. Why is he making more money than me? And that comes down to Greeks. Another time that we really need to think about them is obviously during earnings season. So we're going to cover a little bit of option Greek stuff for earnings today, just because people guess and people try to use option profit calculator, and that thing doesn't work. It doesn't take IV into account. So I want to teach you how, I get asked all the time on Trade Floor, what will these things be worth? And, I always try to tell people like, hey, you're asking me 2 hours after the earnings. This could be completely wrong by open. And then, maybe the stock rips or dumps $5 more, and they come to me and say, well, you were wrong, And so tonight we're going to talk about how to actually look at your option contract and have an idea of what it might be worth the next day. Realistically, not just people guessing, not people on Trade Floor saying, oh, you're going to be up 500%, So as we talk about Greeks, we're going to try to go over just a few different examples, a few different kinds of stocks and things to look out for when you're trading them. And so the first one that we're going to start with today, we're just going to kind of talk SPY contracts and discuss a little bit of the movement that they make, things to look for on SPY contracts. And this is, applicable to, almost like, all stocks, but it's just something that you want to consider when you're entering any sort of trade, to kind of know the type of money you might make, how much money you might lose, how much money you might make, what the moves mean for you, why is your contract worthless at the end of the day. So we're going to talk about all of those things. And so what this is right here, what I've pulled up, this is called the option chain. And for anybody that doesn't know, I use Thinkorswim. I much prefer it. I think it's, the best broker around. You'll get better fills than Webull or Robinhood. You don't have any of the funky messes or limitations, on same days or whatever it is that both of those brokers give you. And so this is the option chain on Thinkorswim. And so you can up here, if you click on layout, you are able to add or remove whatever you want on here. And so these are what I look at as far as Greeks and then implied volatility and then open interest and volume. Those are mostly what I'm concerned with when I'm doing any type of trading. Those are the Greeks that we really want to care about. There's one more, we aren't even going to touch on it. It describes the change in the value of your contracts based on interest rates. I have never once in my life needed it. If you want to look at it, it's this one right here. But we aren't even going to talk it today. It's a not helpful Greek for short-term option traders, whether you're day trading, scalping, swing trading, whatever you're doing. If you don't plan on being in them for a super long time, then you really don't need to care about it at all. And so with that, this is how they're laid out on, for me, this is just how I like to look at them. You can put them in whatever order you want. And so we're just going to kind of go through these different numbers, these different Greeks, things that aren't Greeks but are directly, influenced by Greeks. And I'm going to try to go, somewhat quick on this. So maybe we can start to look at some charts at the end, and you guys can ask some questions about, hey, I'm looking at this trade. What would be a reasonable contract to trade? But with that, the first one we're going to talk is delta. What delta is, it tells you how much money will my contract make or lose if the stock moves $1. So on something like SPY, if we buy 502 calls, and we're talking same days here, so these numbers are going to be a little bit, messy. But if we buy 502 calls and they cost us $18, and it's trading at 501, if we get that $1 move, we're making $35 on this contract. If it moves against us, we are losing $35 on this contract. So, and obviously they're worth 18 now because they're same day, but we're losing $35 on these contracts. So that should be considered in any trade that we are taking. So if we were to, just go to a chart, we'll get SMC off the page. If we go to a chart and we look at SPY, and, we can see when we look at these contracts here, we can see the delta. So a way that I use delta and a way that I like to analyze delta is planning for my move. If we're trading, if we're trading SPY, and we'll just say we're still in this range on the day, and we're trading SPY and we're trading at 499, I'm just picking a nice whole round number. We're trading down here at 499 and you want to get some calls. There is, and at this time of the day, we have never even traded above 501. There is no reason to even consider a 501 call. Obviously, they ended up in the money, probably paid a disgustingly large percent. But you want to say, okay, I'm trading a 499 call. Where is my target? And you want to keep your strikes reasonable. If you go a couple bucks out, what that does is it's going to dramatically reduce the cost of your contract, but it's also going to reduce your delta. So that's how I try to plan things. If I'm looking for, we'll just say we're looking to get back up to this 499.50 from 499 level, I want a contract with as much delta as I can get, because the out of the money contract might be cheaper, but if this move happens, I make more dollar wise with a higher delta. You will make a larger percentage on the cheaper contract, but it is going to be less money with more risk. So I always try to plan it. You don't want to be buying 502 calls when we're at $4.99, because they're going to have like $3 delta or $5 delta. So if you get a $1 move, you're only going to make $5. Whereas if you go at the money, you're going to make $30. So it just adds that additional safety to any trade. And so you should always consider that, because the other side of it is, if you enter at 499, and I always tell people you gotta have a plan when you enter any trade. So say you enter at 499 and you're buying the at the money contract with 35 delta. Well, your stop's 25 cents below you. And we know that delta is, it's based on a dollar move. So if you get a 25-cent move against you, you lose a quarter of your delta. So, when I'm entering this trade and I'm getting calls here, if I have to stop out, I'm risking 25% of one delta, which works out to $8. So now this is a huge part of planning any trade, because you know exactly what your risk is ahead of time. So people see it, when I'm in voice chat or when I post on Tradefloor or even in my tab, if I'm talking about a trade I'm taking, I might say, hey, I'm trying some SPY calls here. You're going to be risking about $8 or $9 a contract. I'm telling you that because I've looked at the Greeks and I'm estimating maybe what I think is $8 or $9 might be $10, might be $7, but you're going to have this rough idea of what you're going to lose. And so it's crucial. Most people, they get it, and I won't say most people, but a lot of people in here, they get into trades and they have no idea of the risk that they are putting on. And so they don't have a stop out plan. They don't know how much money they could potentially lose. And so by the time where they should have stopped out has blown, way past there, they hit Tradefloor and say, oh, I'm in SPY calls, I'm down 50%. It's like, well, was that your plan? Because if it wasn't your plan, you should likely be stopped out. You've all heard me say a million times, like, I'm happy when somebody has a terrible trade go from minus 60% to making money, but also it was a really, really bad trade and not a good habit to have. You're 9 times out of 10 better stopping out because this delta is going to work against you on the downside. So take the tight stop out, and then you know your risk. You risk an $8 and look for a new entry and see if you can get a better entry at a better price. So then the people who ride them, you stop out for 20%. Other people write them down for 60%, and you buy them at that support. And by the time they're break even, you're up 100% on your contract, 120%. If they were down 60% and breaking even, you've now gone up 120%. So always look at delta. It tells you how much you're making. It tells you how much you're losing. The next one that we're going to talk about, and I'm going to do these a little, I guess I should probably I'll put this next to it. I normally don't have it next to it, but let's see, one more. So the next one we're going to talk about is gamma. So gamma is, it's an option Greek that nobody talks about. They should talk about, because the people that love those big old NVIDIA runners or those big old SPX end of day kind of things that run. The main thing really, really working for you right there is gamma. And so what gamma tells us is going to be, how much does my delta change? So, and it's again based on dollar move on the stock. And we're going to kind of touch on this a little bit more after I talk about gamma, but dollar move on the stock, that's an important thing to remember. So if we buy these 502 calls and it moves $1, our delta is going to go from 33 up to 86. That's quick math in my head. So if it's wrong, it's wrong. But going to go from 33 up to 86. So it dramatically increases for you. If you go in the money, gamma will always be the highest at the money strikes because there's a limit to delta. We can't even see it here, but 1 or 100 is the limit on delta. So what gamma is going to do is increase or decrease our delta. So we can actually see just looking at these strikes here. This is the at the money, but not in the money contract. You got 33 delta and you got 53 gamma. The $1 in the money has 70 delta. So over double the delta and only 28 gamma because it can't increase much more than that. So this is what really works for you. When you hit those out of the money SPX that are super sketchy, and I'm for sure not supporting, you might have 10 delta, but on something like SPX, you might have 10 gamma. And SPX moves dollars very quickly. So you are getting, they call it a gamma shift. You are getting an extreme gamma shift in your direction. When you're trading those $5 out of the money SPXs into close, you might only have 20 delta. Well, when it moves $5, which is only 50 cents, your delta is going to be up to like 80. So now all of a sudden, every dollar that it moves is giving you $80 or losing you $80. That's why those SPX are so volatile, because gamma goes both ways. It's how much your contract can lose or make based on the $1 change on the chart. So that's something that we can actually apply to something that we saw recently. And thankfully it was a winning trade, so I'm happy to talk about it. Robinhood ER. And so Robinhood ER, nice big move on it. You know, you look at this move on something like Robinhood, and these candles are gigantic. Well, the people started coming out and saying, oh, you know, my contracts are going to be up, you know, 600-700%, blah, blah, blah. These are going to do 1,000% or whatever it was. Well, an option contract, like, you know, don't get me wrong, this is what, 10-15% move up on Robinhood, huge percentage gain on shares, you know, and so, you know, huge percentage gain on shares, 13%, giant move on any stock, no questions asked. Well, the issue comes into play that, yeah, this is a 15% move. Well, it's only $1.50. So as we've learned from option contracts, Delta, it only cares about $1 move on the contract. So if you buy a $50 contract, $60 contract, and you get $1 move on it, you're only making $35. So it's 50%. So in something like earnings, this is huge to consider, you know, because a big move might happen, sure. However, if it's only $1, you know, like we had somebody in here and she always missed on earnings, but she hit like basically a penny stock. It was a $2 stock and she bought weekly 5 calls. Well, the stock went up 50%. It moved $1. And she thought that she was going to be up, you know, 7,000% or whatever on these contracts. And in reality, they were minus 80% at open the next day. And part of that is, yeah, the stock moved 50%, no questions asked. However, it was only $1. So you only get $1's worth of delta. So that's how they can get, you know, that's why the people trading Robinhood, you know, you had option profit calculated trying to tell you that these things are going to be worth $600, and it's because it ignores IV and stuff like that. But you need to always think of it in terms of $1 move on the stock. Never, you know, percentage does not matter. An option contract does not care about percent moved. It only cares about dollar moved. So that's why people can get so thrown off on trading earnings. You know, well, it's one of the many reasons people can get thrown off on trading earnings. The next one, and I guess I'll adjust these for you guys too. The next one that we're going to talk about, next Greek, is Vega. So it's right here. It's always going to be a very, very small number. And that is because what this is telling you is for every 1% that the implied volatility. So, you know, this is a question we get all the time, especially involving earnings. You know, am I going to get IV crushed? So now we are going to discuss IV crush and how IV crush occurs, what it means, and its relationships with the Greeks. So what Vega tells us is for every 1% that IV changes, it's going to either make your contract go up or down by $1. That's what IV is telling you. That's what Vega is telling you. That is what IV means. Of course, going into earnings, as we all know, IV gets extremely elevated. So we're going to pull up something else here. Oops. Let's see. We're going to pull up something else here. Coin. Because let's talk coin, because everybody's in coin right now, because everybody thought coin was going to go to the moon, you know? So we have a few things to consider here, a few things we want to touch on as far as earnings trades. Yeah, 1K, I wasn't even going to get into T how the gamma exposure is just ridiculous. So coin earnings trade. So first thing we want to talk about, because I get asked all the time, does anybody know the expected move? You know, we see that question on TradeFloor all the time. Well, if you're on Thinkorswim, we're lucky. You can click right here And it is going to, or, you go into your trade tab, and this yellow number right here with the 3 M's by it, that is the market maker's expected move. So this is a very simplified version of what that number tells us. But what it tells us is that, coin was trading at 165 into close. The market makers, where you hear people say pricing in, they were pricing in basically a $20 move. So what that means is when you are buying an option contract, say you're buying these 165s right here, say you just were buying at the money contracts. Well, these contracts cost what they should cost if coin was trading at $185. So basically at this point, and IV, we're going to keep talking IV. Basically at this point, those in the, at the money 165s, if somebody bought them, they will be slightly above break even at the current price. You'll be up, I guess we're up to 189 now. So we're pushing. So you'll be up $200-300 going into the open tomorrow on a $900 contract and catching a $20 move. Well, what this also kind of tells us is if this move isn't met, any of these out of the money contracts are roasted and toasted. These 210s, again, they're priced as if it was trading at 185. What that means is they are way too expensive. 230s, they are entirely too expensive. These things are priced as, priced as if the stock is at 185, Well, tomorrow you have to think we're going into open. And I'm extremely opposed to these far out of the money contracts. We're going into open. It's Friday, so these contracts expire tomorrow. Coin's trading at 190, so you're basically $40 out of the money. You have to ask yourself, what do you think a $40 out of the money contract with 6 hours to expiration is going to be worth? It's going to be worth close to nothing, is the correct answer here. So you have to plan on those being worth close to nothing tomorrow. Well, if you want to know a little bit more about what they might be worth, you can look at the IV right here. And we learned from IV, how much can we lose here? Coin is an interesting one. You aren't going to lose all 260%. Coin consistently trades at, give or take, 150%, 100% IV. So when we look at this, we look at our Vega and we basically say, okay, so we think we're going to lose 100 points of IV. We look over here, and you obviously aren't going to go negative. Oh, sorry, we're on the wrong contract. We're going to lose, okay, we think we're going to lose 160% IV, give or take, So for every 1 percentage point, they are saying we are going to lose $1. Obviously, you can't lose more than the contract is worth, which is, what this is basically telling us. But you are going to lose ballpark $70 to IV. Just based on, how much the IV drops. It will stay elevated. It'll be somewhere between, 100 to 170 IV. So we know that we're basically going to lose 70 cents off of our contracts, no matter what. So these contracts that are worth $89, we're losing $70 to IV, give or take. And that's unavoidable. That is what IV crush is. When IV goes back to reality, contract prices go back to reality. It will no longer be priced at a $19 expected move. So IV alone is going to drop these contracts anywhere from the $50 to $90, because the spread is disgusting, range on them. So they're going to be down very, very bad. And that's how we calculate IV. That's how you go into any of these things, and calculate it. And a lot of people don't want to hear it, but that is, math that you cannot argue with in the market. You can see on all these puts, very, very high IV on them. And so that is what causes IV crush. It's important to remember that, contracts are moving extremely quickly. Implied volatility is changing constantly. So you can't just look at this and say the exact number that is going to be lost, but you can always ballpark it and have a pretty good idea of what's going to happen. So that is the first thing working against you. the next thing that's working against you, and this is going into, the final Greek that we are going to talk about, is theta. So this is theta, got theta in this column. What theta tells us is, yeah, sure, Pedro, I appreciate the direct message. If it gaps to 210 or 220, it could pay. But yeah, I mean, absolutely. If it gaps up $30 more, it will pay. No denying that. But based on prices right now, in reality, without guessing, this is what we know. So the next one that we have is theta. And what theta tells us is how much money this contract will lose going into tomorrow. So what this number is, 68, it's $68. And what this is telling us is how, what this is telling us is tomorrow at close, how much theta will be lost. So this 68 number is applied basically every hour, not $68 an hour, but 68 divided by 24, whatever that is, that many dollars per hour is how much it will be losing. And yes, it happens overnight. So we know between IV, which is we're going to lose, like I said, we'll say $50 to $100 because they're under $100. Then we have theta. So we know that we're going to lose $70 from there. So now we have basically we'll say $140 working against us. Well, we did get a pop, we got a $20 move. We only had 7 delta, which obviously is going to increase as we go. But we only had 7 delta. So theoretically, we're going to be able to make some money on the delta. We have, like I said, somewhere between $150 to $200 working against us. We can theoretically be making maybe $100 to $130 in delta going into tomorrow. So that is going to leave our contracts with, maybe $20, give or take. Quick math in my head. Maybe these will be worth $20 at open. They'll go to zero instantly if they open at $20 and we're at this price. But that's how we can look at this and say, okay, how much are we going to get from delta? How much are we going to lose from theta? How much are we going to lose to IV and Vega? And now you have a very good idea of what your contract could be worth. So you should always take this into consideration when trading earnings. Another side of trading earnings that I want to point out, going back to these 165 calls, you might ask yourself, well, how did I know how much these things will be worth? Well, and I hope most people know what an option contract represents. And what an option contract represents is 100 shares of a stock. When you buy an option contract, you are technically entering into a contract with someone that if these expire in the money, you have a right, not an obligation, is what they say. But if these expire in the money, you now have the ability to buy shares of coin at $165. That's what your contract tells you. So how are we able to calculate things quickly when we end up in the money? Well, if you are at these 165s, and we're pushing up nice now to 190, so you're probably going to be in some profit on these. When you have these 165s, you are up $20 in the money, give or take. So we know that each of those represents 100 shares. So if you are up $1 in the money, your contract will be worth $100 at expiration. So if you're $20 in the money, you'll be doing about 100% on these 165s at give or take $2,000, So that's how you can calculate it. That's what's known as intrinsic value of an option contract. That's how you're able to calculate it. And that's why you will see, people like me and MMA and stuff saying, you want to end up in the money, because in the money gives you that intrinsic value that can't be taken away by IV, theta, all of those things working against you. When you have intrinsic value, your theta drops to nothing. You can see these ones right here. Yeah, these were $300 contracts, the 190s. You're going to be losing $300 to theta by close tomorrow. So that's instantly taking them to zero, but you're going to get a nice move on the delta. So these 190s will be worth something tomorrow because you're ending up pretty close to the money. IV will stay elevated on them. But if you're ever curious, what is my contract going to be worth? Add your delta, fudge the number higher because, it will be increasing. Or if you're works the same on puts, fudge the number higher because you will be increasing. Then go figure out your Vega IV conversion, and then go to your theta, subtract that as well, and you will have a pretty good idea of what those contracts will be open. So just wanted to use the coin as the example to show, what you should be looking for going into open tomorrow. It is important to remember coin is a very high IV thing. It will likely carry high IV into tomorrow. So you might be able to sneak out with some money on these. But you might not, if we, and as people keep saying, we're talking about the price that coin is at right now. We get a gap up to 200, 210, any of those prices, yes, you will start to make money on these because we'll beat the expected move. So all of that pricing in will be gone. You will have got a huge amount of delta from the move. You'll be winding up closer to the money. An interesting thing about delta, I meant to include this earlier. These numbers over here, a lot of math goes into calculating it, but a very, very simple way to look at this look at a delta number. Delta is telling you this number, the percentage chance of ending in the money. So 230, we got a 7% chance of that thing going in the money. Is basically what it's telling us. So that's what delta's, that's a really great way to look at delta. And, when you're buying a 10 delta contract, that is basically telling you there's a very, very low chance of that contract going in the money by close of, or by expiration. So that's my spiel on Greeks. I think I saw a couple questions that maybe I missed. And so we'll go over those and then we'll talk about it. Oh yeah, 1K. I'm just gonna pull it up for fun. So T, everybody knows I love to trade T. You got these contracts right here. If you look at it, so we got a 17 call, you're in the money. It costs you $13. You get 65 delta for $13. Don't get me wrong, a $1 move on T is huge. And then you see right here, these gammas, 157 gamma. You won't actually get that much because the most it hits is 100, but look at this shift from 17s to 17.5s. You go from 10 delta to 65 delta. So you can take extreme advantage of things like AT&T when they are trading right at the money like that. And because something that is very good for contracts is going from out of the money to in the money. You are dramatically increasing your potential profit. If you can go from one strike out of the money to all of a sudden in the money, you make really nice money doing that. So if you can catch those shifts from, that's what I did. I swung AT&T yesterday, trying to catch the pop over into 17. And we can even look at the charts on these. So I swung these, I think I still have this linked. I swung these next week 17 calls because I wanted a little bit of safety. So, and we'll pull up the T chart next to it. I wanted a little bit of safety on this trade. So I went for the next week's going into close yesterday. They cost me $17. That was it, and there I am. I'm in that one right there. So I filled between 16 and 17 on them. So that's me getting in right there. And then you look at AT&T and it did make a nice move. This is 10 cents. A 10-cent move up on my contract paid me 50%, just short of 50%, don't get me wrong. But a 10-cent move up on the contract paid me 50%. Then you get this pop because you're in the money and all of a sudden you're up almost 100% on these things. Oh, I guess over 100%. I got out at 30 and I got out at 30. But you're up 100% on a 20% move upside. And that is because you had that extreme shift in delta where all of a sudden every 1 penny you're making is paying you $1. When do you buy before ER to take advantage of the IV run up? Well, so that's very tricky and it's really stock dependent. On something that has extreme volatility and will get very high IV, something like coin, you kind of want to buy in early in the day of earnings. You are accruing a huge amount of risk because as we just talked, those contracts are extremely inflated in price already. However, the change in IV from 8 o'clock, sorry, on West Coast time, 11 Eastern time to close will be dramatic. So I bet we can pull up some coin contracts that were bought here and were worth more lower at the end of the day. And that is because the IV is shifting dramatically in your favor. The other way to do it is get in about a week early. However, when you have volatility, when you have moves like this, like if you're trying to catch a put run up on coin, you got obliterated. So you need to be very cautious of volatile moves going into earnings. But the best way to take advantage of IV shift, and something that I do frequently because I don't love to trade earnings, take advantage of the IV shift up or down for you, trim, say you got 5 contracts, take 4 of them off so that the money you made in that IV shift is now financing your 5th contract. So your potential loss is much smaller that way. How do you figure out the expected move? Very great question. Let's pull it up. So you want to know the expected move of AT&T. So you go to what is known as the front month contract. And so what the front month contract is the monthly expiration of the next month. That's all you do. Then you go and you do a straddle. So what you want to do here is, and this is going to be wrong because, because tomorrow is OPEX day for these, so this is going to be different for us. But what you do is you go here and you take a straddle. So what you do is you add these two together. And you just want to be right at the money. You take the at the money call and you take the at the money put. So we're going to add 12 plus 32, $44. Is that right? That's what's in my head. And then you multiply it by 0.85, if I remember right, something like that. And so for right now, going into the next month, we are looking at a 37-cent expected move. This is saying 22 cents, but we are looking at a 37-cent expected move right here. And part of this being off is that, we are in the money on these 17s and a little out of the money on the 18s here. So it's a pretty big difference on something like AT&T. But you take the at the money call, at the money put, add them together, multiply by 85. Actually, if somebody has a second and you want to fact check me on that 85, then you should, you're more than welcome to. I think it's multiply by 0.85. Sorry, 85%. I could be wrong though, but if somebody wants to check that, you're more than welcome to. But just take the straddle, multiply by 0.85, and it'll tell you what it is. Let's see what do we got here. Is there any downside to starting in the money? Yes, if you're wrong. That's where the real issue arises if you're starting in the money. So we'll look at SPY. Right here, if you're trading some in the money calls right here, gamma is going to work against you and it is going to work against your delta, and you're also going to have theta working against you. So if you're in, say, these 501s and it drops out of the money, you're going to lose $1 worth of theta, or $1 worth of delta, so you're going to lose $57. Then your delta is going to drop while theta hits you. So a $1 stop on SPY is like, if it's a longer term trade, isn't an unreasonable trade. However, you need to acknowledge that you are going to lose a bunch in delta dollar wise. And so the stop, you're going to be risking 25-30% just having a $1 stop on this. You can start to play with the delta a little bit and plan your stop on it. But when you make that move from out of the money to in the money, in the money to out of the money, your contracts will get beat up pretty bad. So it does carry some inherent risk. But on something like AT&T, I'm almost always going to go in the money for being reasonable, like when we're trading at 1710 or whatever, I'm not going to trade 1750s because I know that a 40-cent move upside on T is big. It will give you a really nice percentage, but I'm going to trade the 17s and I'm going to say, okay, my stop is 10 cents below me. So I'm going to be risking 1/10 of my delta, which is frankly going to be, $3, $4, $5, whatever it is, not very much dollar wise. So on something that's a slow mover, it can be fine. On something that's expensive, your SPYs, your NVIDIAs, your Teslas, you're going to get obliterated if it drops out of the money. Oh, how soon do they figure out the expected move? I read that wrong, 1K. I thought you said, how do they figure out the expected move? Google's expected move. I got no idea what its expected move is, but it's Google probably has some weird things going on because didn't it get smoked after hours? Google's current expected move is $1.40, but that could be playing into tomorrow. And I think some news came out. Oh no, it didn't. I saw people saying I got tricked again. Of course, it hardly even moved on that news. Uh, Oh, you Googled to check my 85% and I was right? Nice. I love it when I pull a correct number out of my head. I knew I was close. I knew I was close. Okay, so with that, what questions do you guys have? Is there anything I covered too fast? Do you understand delta? Do you understand theta? Do you understand the relationships between all of these things, how they affect how contracts move, as well as, why we tell everybody quit buying stupidly out of the money contracts. That's not good trading, Like I know we've had the degens in VC lately just piling into $80 out of the money SMCI calls, but it works until it doesn't. So be very careful. Can you explain why leaps are better than shares in terms of Greeks? So first, I for sure don't want to say that leaps are better than shares necessarily. I will say that leaps offer some advantages versus trading shares. So we can just look at it. I should probably get my calculator out so I can give you like some more real numbers. Okay. So let's say we want to look at we're bullish long term on Google. And this is actually, I'm happy you brought this up because this kind of plays into like some things people keep talking about in the market, like Pelosi's trade that are dumb, But this, we'll use Google as our example just because we pulled it up. And so the advantage from leaps, and again, I'm not saying they're better or worse, but it all comes back to Greeks and a leap can be a better or a potentially more profitable way to trade things than shares. So the first advantage to a leap actually has nothing, well, I won't say nothing to do with the Greeks, but the advantage to the leap is that theta is not especially a concern. It's $3 a day. It's basically costing you, and we're just looking at these Januaries at the money. It's basically $3 a day. So the time decay that is the issue with option contracts and why people frequently lose money is they don't buy time. And a big part of options being more expensive a long ways out is you're paying for time. You're paying for that safety. And theta is time decay. That's what it is. So we have very, very little time decay on these. So it adds safety if you're trying to trade some leaps. Where the biggest and advantage, I'm going to say that might not be the best word, where the biggest advantage for these lies is in the delta. And so we know that for every $1 we move, we can for every $1 Google moves, we know how much money we will make delta wise. So when we look at Google 145 calls, we see we have 60 delta. So we know for every $1 Google goes up, right now we're going to make $60. As you can see, the deeper in the money we get, thanks to gamma, our delta increases. So we're going to make $60. Well, you might ask yourself, why is that an advantage? Well, if you think of delta in a slightly different way, think of every one delta as one share. So this is the same as if we had 60 shares of Google, for every $1 Google goes up, we make $60. We have 60 of them. If each one goes up $1, we make $60. Well, these contracts cost $1,700. So, it's expensive contract, like price doesn't necessarily matter right now, the specific price, but they cost us $1,700. If we wanted to go out and buy Google right now, and let me consult my calculator, if we wanted to go buy 60 shares of Google right now, trading at $142, it would cost us $8,566. So we get the benefit of 60 shares for $1,700 as opposed to $8,500. So it gives you a pretty dramatic savings. It's important to remember you have 60 delta. These are $1,700 contracts. So if Google goes up $1, you're going to make $60. So if you think Google is going to go up $1 in the short time frame, you don't want to get a $1,700 contract to trade it that way. However, if you're long-term bullish on Google, then you can put the $1,700 in, make your $60. But we can see here where this starts to get more and more beneficial. Your cost basis is $1,700. Well, the deeper in the money you get, the more benefit you receive. So you're still, we might get deeper in the money. These things cost you $1,700. Well, if we get even deeper in the money, you might get up to the benefit of 70 shares instead of 60 shares, without changing your cost basis. Whereas shares, you would have to add 10 more to get that benefit. So they can offer this is why options are leveraged. That's what that means, is they are leveraged. So it gives you a way to trade some leverage shares, basically. So leaps are an extremely safe way to be long-term bullish or bearish on things. Don't buy leap puts. That's rarely work, but if you're long-term bullish on something, this can be a very, very great way to do it. Then if you remain very bullish on Google, say you're in these 145 calls and it goes to 175. Well, your contracts are going to be up, appallingly. You're going to be up thousands and thousands of dollars then. But if you want, you can actually make the decision to exercise and get your 100 shares of Google at the cost basis of $145. You can turn around and you can buy those, your 100 shares, because that's what an option contract represents. You can turn around and buy your 100 shares of Google, and then you own them. Or you can always just sell the option contract, $20 in the money, and make a bunch of money that way. Add $2,000, $4,000 on that contract then. So that's the main benefit with leaps. Again, I won't say they're better or worse. Something that you always have to consider is if this trade goes against you, you can lose a lot of money as well due to this elevated delta. So, leaps aren't just instantly super safe things or anything like that. But they offer you a way to have some leveraged exposure to the market at a bit of a discounted rate. Hope that answered it. Okay, well, if any other questions, hopefully we covered all things. We've covered, shorter time frame stuff, longer time frame stuff, why it's better to be, generally speaking, closer to the money, why you don't want to go way out of the money. Hopefully details on all the Greeks that matter, especially as day traders, you should really focus on delta, really focus on theta. And then for the earnings degen traders, always take IV and Vega into consideration. They're going to tell you how much you're going to make or lose on those contracts, generally speaking. And then again, just the disclaimer, we talked about coin at this exact price. It could rip tomorrow, it could dump tomorrow before open, and everything I said will be wrong. But just wanted to discuss it at the current price that it is trading at. So hopefully we got it all. Unless anybody's got some more questions, I'm happy to answer them. Otherwise, we can call it a night. What do I mean? So when I'm trading, I'm a very, cut and dry trader. So I buy calls at support and I sell at resistance. That's what makes me close contracts, is like when I enter a trade, if I buy calls here, my stop out is down here. No questions asked. I take profit, I take profit, I take profit, and I'm moving my stop up the whole way. So I go into everything with a plan. I know exactly where I want to sell. This was a trade we took in voice chat today. Double top on SPY. So figured try to short SPY up here, and so we did. We shorted SPY. Obviously went a little bit against us for a second. This is our stop. Never had a close outside. We're risking 10 cents against us, and ultimately ended up getting the really nice flush. No denying the 500 dip buy was the real trade. But double top on SPY, stop here. I trimmed a couple here, and then we get this nice flush candle. I'm out here. We went to 500. That's, and even broke trend, I'm out of the trade here. No questions asked. So all of my trades, extremely cut and dry. I know where I'm entering. I know where I'm stopping out. I know where I'm taking profit. Then when I'm looking at the move I expect to make, then I decide, okay, what contracts am I going to buy? If we're breaking into opening range, I think we're going to push to the top opening range. Maybe I do trade 501s because that's still a reasonable strike. Or I trade 500s for that safety of potentially getting in the money, and having that intrinsic value working for me. But for me, always very cut and dry. I, of course, I'll pull them up. I of course use some indicators too, EMAs and VWAP. That's all I use. I'm a very simple trader. So if I'm getting long down here, start trimming at VWAP or start trimming at EMAs. You don't ever know if those are going to break, but always know some targets. Why is the volume higher on the 165s than the 60s? Oh, probably you're probably talking on Google. I don't know. Let's pull it up. I mean, well, the volume on the 160s and the 165s, they're 40 apart. So, I mean, I don't know. That's not much. Oh, and it's actually lower on the 165s. So I don't know what you're talking about. Right on, Shanks. Thank you. 1K. Thank you. Yeah, thank you, everybody. I appreciate y'all for being here. You want to set up your charts like mine? Well, hop in VC and I'll just explain it to you. It's a piece of cake. It's 3 EMAs and VWAP. That's literally all there is. Oh, 160 and 160 and 155. I don't know. I couldn't really tell you that. It is interesting to note that yes, the volume is lower. The open interest is much higher. So these people are, there's more people in here technically. There was just less of them traded. I guess I should have talked about that. Open interest updated once a day, only in the morning. Volume updated throughout the day. Highest volume chain today on these leaps was 185s, oddly enough. Which EMAs do I use and why? I use the 9, the 20, and the 50. Those are my most common ones. I like the 9 because it obviously defines trends very well. So buying pullbacks into it or buying, rejections off of it works really good. 20, I frequently use as a stop out for which is this orange line. I'll frequently use that as a stop out for my 9 EMA trades. That's the main thing I think about it for. Or if we're getting a nice pullback in a strong market, I'll buy the dips to the 20 if they come with a stop below it. And then the 50, which is this yellow line, I use it for trend reversals. I want to see us breaking up, holding the 50. We get a pullback to the 50. When we bounce the 50, you can start to pretty comfortably say, trend is turning around from down to up or whatever it is. And then VWAP I use because this is a simplification, but if we are above VWAP, bulls are winning. If we are below VWAP, bears are winning. If they're sideways, EMAs are VWAP, completely unhelpful. But if we are above VWAP and trending up, we know that the long traders are making money and bears are underwater. If we are below VWAP and trending down, we know that the bulls are now the ones underwater and the bears are the ones making money. And then VWAP, I use the one on Thinkorswim because the one on Webull, the VWAP 14 is garbage. Did I answer your question though, Josh? Was I too fast? These two, 155s, 160. Yeah, nice. And yeah, this is just, I mean, to be honest, as you can see, there's just not a lot of people trading these right now because, I mean, Google's doing good. You don't really need to be taking the super long-term bets on them. Obviously, some people are, but nothing too crazy, on these longer dated things just yet. Okay, well, if that's going to do it. No, I mean, well, it all depends on your plan. So with a leap, you can, I don't want to say you can go further out the money and you're going to be okay, but you don't need to go right at the money. Like if you're long-term bullish on Google, don't be scared to go $10 out of the money because you have a year for that move to come. You aren't trading leaps for huge returns in a short amount of time. That's just not what they're used for. You need to think of them more like a share trade where, like, you got 50 delta. So if you get a $5 pop, you're going to make $250 on these 155s. I mean, you'll make a little bit more because delta will increase. You're going to make $250 on these, which is 20%. So it just gives you that leverage as opposed to trading shares. But just keep your strikes reasonable. Like, if I was trying to get into Google Leaps right now, I'm not going 180s or anything like that. I mean, or look, these 200s, 32,000 volume. That's not how I'm trading them personally. Could they potentially have a great return? Sure. But you got 16 delta for $265, so you need a multi-dollar move just to make 10%. So I don't like to be, way out of the money like that personally when I'm trading them. I'm always going to keep, on Google, something $5-10, is where I would go. Amazon, something like that. Things like Tesla or big movers, Microsoft. So you can obviously go a bit further out. But on some of these cheaper things, $150, you want to keep them pretty reasonable for the strikes. Right on. Okay, well, if that is going to do it, thank you so much, everybody. I really, uh, really appreciate you guys for coming. I know Greeks are a little, technical. We're going to get back to just some good old-fashioned charting explanations next week. Just been trying to get some of these technical things out of the way so people can access them, and if they have questions, they can ask them or hopefully learn something. So thanks everybody. You all are the best. I appreciate you taking time out of your day to be here. And tomorrow, Friday, love to see it. Everybody have fun, trade safe, don't degen things, and we'll be good to go. Yeah, thank you all. Have a good one.